Hey there, everyone. Happy Monday, February 3rd. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a winter wonderland, a very snowy Redmond, Washington. Thanks for joining me here every weekday after the close as we break down the market action. Apologies ahead of time. I'm fighting the flu. My entire family is fighting flu A right now, so hopefully I get through the show no problem. But apologize if I have to take a little cough break occasionally here. Had to do a show today because, of course, quite an interesting day. You ended up almost having a 90% down day for the major averages. There's enough of a rally in the afternoon to sort of alleviate that, but a 90% down day is when 9 out of 10 NYSE members or S&P members, however you want to break it down, 9 out of 10 of them go in one direction. So 90% up days, 90% down days usually are a pretty significant event. Earlier in the day, it looked like 90% down, but going into the close, we sort of alleviated that. However, the damage was certainly done, right? The reaction to the Trump trade discussions and tariffs over the weekend, certainly feeling it in the form of the major averages coming off. Cryptocurrencies, Bitcoin, etc., sold off pretty aggressively. All recovered going into the end of the session. However, a lot of damage done, and we'll look at the sector themes. We'll look at the heat map. We'll look at how our market trend model may be in the process of changing because the short-term model is starting to show signs of weakness with today's distribution. With that in mind, let's look at the charts here. All right. Looking at the major averages here, the S&P 500 down about 0.8%. We actually closed just slightly below 6,000. We got down to almost 59.25, we'll call it. But back below that sort of major big round number milestone. The NASDAQ even worse, down 1.2%. Mid caps and small caps all in the red as well. The S&P 600 small cap index down 1.5% today. The VIX was pushing toward 20 earlier in the day, and actually did briefly. I was going to say, I thought it briefly got above 20. About an hour into trading, we spiked above 20. It came off a bit, and as stocks rally going into the end of the day, the VIX ended up settling in around 1850. So, the VIX technically still in a low volatility range. And unless the VIX starts pushing above 20, then I think that's not a concern just yet. However, we're really close to pushing above there. The VIX overall has been at a much higher range than it has been, just in the last 3 months. You're seeing the VIX a little more elevated, but still below that 20 level for the most part. So we'll keep an eye on that and see how things may play out. Looking at interest rates, you can see 10-year long bond yields all moving down slightly. The 10-year point right around 4.54. The long bond yield just below 4.8%. So we've seen rates continue to come off a bit. The longer term trend in rates, I would argue, still probably in an uptrend of higher highs and higher lows. But in the short term, you're certainly seeing rates come down a bit. The dollar index continuing to push higher. That's arguably one of the biggest risks, I would say, of the markets here is a strong dollar. Actually had a really good conversation with Jay Hatfield, CIO of Infrastructure Capital Advisors, on the podcast last week. I think we released that on Thursday or Friday. I would strongly encourage you go and listen to that one. Also, while you're at it, listen to the conversation with Peter Bookfar. Both of them talked about great macroeconomic takeaways. Particularly, we talked about the dollar and interest rates in both of those conversations. I think you'll appreciate that very much. All right, precious metals continuing to move to the upside. You can see the GLD up another 0.5%, about the same for silver. Crude oil was slightly lower, but all the rest of the commodity ETFs we track here in the green. Look at how Bitcoin reversed so aggressively earlier in the day over the last 24 hours. Got down to just below 92,000. That's how much we'd come down from 106,000 over the weekend. Through the course of the equity trading session, cryptocurrencies pushed back higher. Bitcoin currently trading right around 102,000. So that 100,000 level, that big round number, continues to be key. Continues to be a pivot point, I would argue, for Bitcoin. I think as long as it holds above 100,000, that's a pretty good chart. And honestly, more than anything, it's kind of range bound. I did grab the chart of Bitcoin, I believe, for the chart review. We'll take a look at there, but it really is more of a sideways phase. And I think that's the reality facing cryptocurrencies, facing the S&P and the NASDAQ. They're really more sideways. And while you could argue that the long-term trends are still bullish, The short-term trends are really more volatile. It's really more in an equilibrium kind of phase. Let's see how things play out through the remainder of this week with a lot of earnings coming out for sure. I think it's about 18% of the S&P reporting earnings this week. All right, looking at the 11 S&P sectors, you can see half up, half down, essentially. 6 of them in the green. Energy, the XLE was up 0.6%. Utilities up 0.5%. Healthcare and staples tied for third, around 0.4%. So this was not a growth-led rally or any sort of any sort here today. This was more value and defensive sectors at the top of the list. On the downside, even with Palantir gapping higher in the after hours, and someone mentioned up about 19%. Yeah, great earnings and so far ripping to the upside. Palantir, honestly, one of the outliers in that it's been a consistent chart, just a beautifully consistent uptrend phase. So it looks like that trend will be continuing until further notice. But the technology sector down about 1.4%, consumer discretionary down 1.3%, industrials third from the bottom, down about 1%. A couple things. Earlier in the day, the breadth was actually a lot more negative, and this is why you don't want to draw too many conclusions during the day because there's obviously a lot of game left. By the end of the day, about a 2-to-1 ratio of stocks down versus stocks up. Earlier in the day, it was about an 85 to 90% decliners versus advancers for the S&P 500. So a lot of stocks actually ended up recovering through the course of the day, still way more down than up. And you're seeing, the breadth conditions overall have been okay, but at best just okay. And I think we've seen that in the advanced decline lines, not supporting the most recent highs. We've seen that with like the McClellan oscillator rotating lower. Wouldn't be surprised if after the day today we see those push lower. We'll see. We'll see what happens. The market trend model for me, I don't update until Friday after the close. And last Friday, there was no change to the market trend model, remained bullish on all timeframes. However, with today's sell-off, you can see in this the stock charts widget does update at the end of every trading day just to refresh on what the current readings would be. I like just knowing where they're at, but then Friday at the close is when I sort of make an official change to it. But you can see with today's sell-off, if today was Friday, short-term model would actually be bearish on all the major U.S. equity indexes, and on small caps, the medium-term model would also be bearish. So quite a warning sign here, I would say, for for me, because the market trend model for me is my main kind of trend analysis tool. This is the way that I think about risk. This is the way I think about positioning. And the medium-term model is the most important one to me, but the short-term model always triggers first. And so those initial bearish signals could lead to further deterioration. So something we'll certainly continue to monitor through the remainder of this week. Most of the Magnificent Seven, these mega cap growth names in the red today. Tesla, just the dog today, down over 5%. I did grab the chart of Tesla, the chart of Apple as well, down 3.4%. These are stocks struggling here. Tariff wars with China definitely not helping Apple, I would argue. So we're seeing some red there. Nvidia down almost 3% as well. Now, what's up? Meta up 1.2%. And we've talked about how Meta becoming a bit of an outlier in that it's so strong, while a lot of the other Magnificent Seven is not particularly strong today. But, the average Mag 7 name did not do particularly well today. And that, I would argue, is one of the key stories here for the major averages. All right, let's look at the market carpet. And this visualization is brilliant for helping you just visually see what the landscape of stocks was today. And by the way, I do see some of the questions coming in. I can see any of the questions you put on any of the live streaming platforms. We're on Facebook, LinkedIn, YouTube, and X. I can't tell you how much I appreciate you guys tuning in live, those of you who are doing it, and ask questions as they come along. I'll try to take a question or two before we wrap. And anything we don't get to, we'll put in the mailbag. Had a really good all mailbag episode on Friday. Excuse me. Planning another one this coming Friday as well. All right. So what stands out to me looking at the heat map? I mean, obviously, Apple and Nvidia down so much, Tesla down so much, that hurts. And particularly in technology, which has been an area of focus for so many investors. I think the problem for technology for a lot of investors is as 2024 was so strong, if you had bets in the technology sector, they probably became bigger and bigger bets in your portfolio. That's what happens when the price appreciates to the degree that it did. The problem there is when things sell off. All of a sudden, you have big exposure, and you have to give back some of those previous gains. So Apple and Nvidia both feeling some pain here. I would say from a technical perspective, very much rotating from a bullish phase toward a bearish phase. Still open question, but Nvidia now below support, I think clearly. Apple in full pullback mode. I mean, there's been like 1 or 2 up days in the last couple of weeks, it feels like, for Apple. So these are charts in distribution in the short term. Enough of those other names like Meta and others have been strong enough that it's been keeping the benchmarks in good shape. But I'm starting to question that one a little bit. All right, looking elsewhere, industrials a lot in the red here, and that's one of the things I like about the heat map. You start to see which sectors are sort of dominated by green or red, right? Which ones are struggling. So, for example, technology actually quite mixed. Even though there's a lot of red in there, you see like IBM, SolarEdge, Enphase, some of the renewable energy names getting a counter trend bounce. In industrials, it's a lot of red in here. Some random names kind of up, like Raytheon, ADP, Waste Management, but overall, that's a pretty ugly day for the sector. And across the board, very much a mixed results kind of day. You can see a lot of names up, a lot of names down. I didn't grab the charts of Visa and MasterCard, but I'm intrigued by the fact that those are both up today, because these are stocks that have made new all-time highs here last week and continuing to push those to the upside. Some of the better charts in there. When in doubt, follow the trends, and trends like Visa and MasterCard continue to be pushing to the upside. I would also say in consumer discretionary, a lot of red here. I did grab the chart of NVR, which is one of the home builder names, because it's just recently breaking down through support. But a lot of the other home builders very much in the red as well. You can see Pulte there, Lennar, and some of the others also in the red. Gambling names, boy, Wynn looked like it was bouncing last week, giving back a lot of that today, down almost 4%. So weakness, especially in consumer, in industrials, and technology by my read, but very much a mixed kind of modeled appearance to the heat map across the board. And again, I'm as always reminding myself that regardless of what I think the market may do, I should always be happy having a portfolio of things like Visa, MasterCard, Palantir, these stocks just kind of in consistent uptrends. I don't personally own any of those in my portfolio just through ETFs, but I would say, stocks like that, or remember, names in consistent uptrends, I think of those as core positions, and let the chart tell you when it's no longer a good time to be in those names. But for now, those are stocks continuing to get it done. All right, looking at the daily chart of the S&P 500, I updated this a little bit over the weekend as I was prepping for my members-only report. And I was just reflecting on the fact that 6,100 seems to be the new sort of ceiling in the market, right? The new level at which we're facing resistance. We first reached there in early December. We actually tested it a number of times in early December, retested it in mid-January, now in late January, and now gapping off of that 6,100 level. So on the downside, you have 5850. That's a level we've talked about many times. That was the swing low from November. That was the gap here in early November around the elections. You can see swing lows in mid-late December, also mid-January. We briefly broke below there and then came back up. So I would say that this market is at best in a sideways consolidation phase between 5850 and 6100. And I'm pretty happy patiently waiting for one of those breaks to happen, right? And either we break above 6100, which means long and strong Q1 is way stronger than you may have expected. Excuse me, break below 5850 sort of rekindles these concerns we had in early January about a potential breakdown through support and a new swing low. So for now, we're kind of range bound between those two those extreme points. 6,100 on the upside, 5850 on the downside. My my gut would be that we break down before we break up, just given all the topping signs that we've been talking about, right? The bearish momentum divergences, the bearish engulfing patterns that we noticed on Friday's show before we took some questions, highlighted on the S&P, the bearish engulfing pattern, and a lot of other individual stocks as well. So, I mean, my gut tells me that Q1 is going to be more uncomfortable than we've experienced so far. But we'll see, right? And again, wait for the chart to tell us which way, in particular, that's going to it's going to break. All right, that's the daily chart of the S&P. Let's look at some other charts and asset classes. I didn't grab any other breadth charts, and I would just tell you that the breadth conditions in general are not particularly constructive. And we covered that last week. I think pretty wholly. The advanced decline lines all making lower highs in January, while the S&P and the Nasdaq testing new highs. You can see other breadth indicators. I'm thinking the percent of stocks above their 50-day it was right around 50% as of Friday. I should actually check that and see where it's gone today. So we'll digress a moment and look at that one, because it was right at 50%, and I wouldn't be surprised given today's drop if we would have pushed slightly below that. Yeah, so just around 48%. So, excuse me, that indicator at the bottom is the percent of S&P 500 members above their 50-day moving average. We highlighted, in the fourth quarter, how we had pulled back to 50%, finally broke below 50% in mid-December. And that, to me, felt like a pretty negative sign, because we'd spent months and months above that 50% level. We broke back briefly above there mid-January. And as of today, we're actually going back below that 50% point. It's not necessarily end of the world correction kind of signal. For me, that would be more the longer term breadth indicator, the stocks above their 200-day breaking below 50%. We're still well above that, but less than 50% of stocks above their 50-day moving average just tells you that a lot of individual names are not holding that basic kind of short-term support level. The S&P is just slightly above its 50-day moving average as of today's close, but I think that's something to certainly watch through the course of this week. All right, Bitcoin. So while the S&P, I would argue, range bound, right? Sort of, clear resistance around 6,100, clear support around 5,850. We wait to see which way that breaks. Arguably, Bitcoin in a very similar kind of structure. You can see on the upside around 108,000. That was the high from mid-December. Also the high from a couple weeks ago, from mid-January. On the downside, around 92,000. We have the low from late November, a series of lows in December and January. And today's low, we traded right back down to 92,000. So Bitcoin also in a consolidation phase. And in this sort of environment, you wait, right? From a technical perspective, I think either you're short-term enough that you're trading swings between those extremes. And I don't have a problem if that's your time frame, sort of betting on short-term swings. That's where I would use a shorter-term RSI on the daily chart. That's where I might look at an hourly chart and get some confirmations. That's where I might use like the PPO or the MACD on an intraday chart to look for some of those short-term swings, or at least on the daily chart to identify some of those reversal patterns. I think that's fair. For my style of investing, though, I'm waiting to see which way we would break. I think Bitcoin above 108,000 after establishing that resistance in December and then again in January. I think that would be pretty significant. To the contrary, breaking above below 92,000 would be pretty negative. I would also note that the RSI, the RSI for much of this pattern has been range bound as well. We can see that the RSI is between 40 and 60. So you wait to see which way this breaks and where the RSI breaks as well. So you want to break out on overbought conditions or a breakdown on oversold conditions. And I think whichever way that does it, that would be the next big direction of momentum to most likely follow. So Bitcoin, I think, similar to other risk assets, consolidating, wait and see mode. And I think we have some clear support and resistance levels to keep in mind. So Nvidia not doing well is the official technical opinion here. The chart of Nvidia, similar to Bitcoin, similar to the S&P in a consolidation phase. You can see Nvidia with support around 132, resistance around 150. We had a well-established range there for about 3-4 months, right? November, December, January, all kind of settling in there. Then we had this big gap down about a week and a half ago. That took us below the lower boundary. But then for the next week, we're just sort of in that same range, right? So when you have a gap, it's all about what happens afterwards. And do you see buyers coming in thrilled to own Nvidia at a steep discount, or do you see additional selling as investors are not done unwinding positions in Nvidia? And I think up until today, that was not particularly clear. Now, today did close above the open, but certainly this sort of appears to be breaking below the lower end of that consolidation range from the last week. Also gets us firmly below the 200-day moving average. Paul Tudor Jones famously said, nothing good happens below the 200-day. So a chart like this, I'm happy waiting for it to get back above the 200-day, and until then, avoiding and looking for greener pastures elsewhere. Now, The semiconductor ETF, despite NVIDIA's lower open today, the SMH, the stocks remain range bound. The SMH, you can see clear support around 235, clear resistance around 260. Similar to previous charts, the RSI is kind of in the middle of the range, rotating around that 50 level. So this is a consistent theme, I would say, from a technical perspective. The markets are saying wait and see. Gap down in the SMH is negative, but not breaking below support is not so negative, right? Today, we are closing back below the 200-day moving average. That's not good, but we're holding 235. That's where I have an alert set. It did trigger earlier today because we just briefly touched it for a moment, but we closed back above just under 239. So I would continue to watch that 235 level. If charts like this break that kind of support, I think you move on to something else and you wait for signs of accumulation, which we're not seeing yet. Now, Apple had one of the more significant bearish candle rotations on Friday. We had an open around 247 on Friday session, but we closed down around 236 today, opening lower around 230 and continuing to trade lower. Now, we're still above trendline support, or I guess price support here around 220. That's the low from early November. That's the low from mid-January. That's the 200-day moving average. I'm happy still holding a stock like this, and I don't own Apple right now directly, but I would say with a chart like this, if I own some back here, I'd probably still be holding it to see if it would hold this level. But if we would break that, I would say from a technical perspective, there's not a lot of justification to continue to hold a name that is breaking down through all of those levels after failing to regain the 50-day moving average, breaking below the 200-day. So for me, 220 is the trigger. We close below that in the through the course of this week. I think that'd be pretty dangerous. Tesla, a down day, gapping lower about 5%, but you can see still holding support. This is around 380, so that's the low from right at the beginning of the year, second week in January, and today, right around that same point, around 380, very close to signaling a breakdown. I think Tesla breaking down through 380 probably opens the door to retest the 200-day moving average, retest this resistance range from back in July, August, September, October. That's quite a ways down. That's another 120 points below current levels. So I think holding this support level this week is pretty key. So while a lot of these charts like Tesla, like NVIDIA, like semiconductors, not horrible charts, for now they're holding support, but they're right there. And I think a lot of these charts a very small distance away from looking like a very clear distribution sign. And I would argue highly likely that we go much further to the downside. Home builders have not been doing particularly well. Part of that story would be interest rates, right? And so when interest rates have remained fairly elevated, that makes homes less affordable, because if you're taking on a mortgage, it's certainly hitting your rate. But I would say with NVR, what strikes me about this chart is how it's held trendline resistance very, very well. I actually drew this trend line using the October high, the November and December highs. You can see that lines up almost perfectly with the highs mid-January, and we've remained below there. So classic downtrend behavior, right? Lower highs, lower lows, and it's even just this perfect channel. And what you can do with this, by the way, and most platforms have the ability to do some kind of channel. I know on stock charts, what you do is you hold the command button. Is that true? Yep. Here we go. So there's our trend line. We hit command and it draws a parallel line. Look how well, like the lows, it's not perfect, but pretty good. A parallel trend channel of lower highs and lower lows. That means as a contrarian, maybe I'm looking for, a mean reversion trade off of the lower trend line, because that's served pretty well here over the last couple months. But the longer term, that medium term trend is clearly lower. We're now below the 200-day moving average. And after that latest bounce, we stalled out at the 200-day a number of times. This is a chart in distribution mode. This is the kind of chart I would be avoiding until proven otherwise. But I think that trend channel tells a great story about the overall technical configuration for NVR. A lot of other home builders kind of similar. Palantir reporting after the close, as a number of you mentioned. We'll take a quick look here in the after hours. Let's see. So we go to the symbol summary page. Yeah, boy. So up huge, another 19 points in the after hours. That's up about 23%. So earlier, as we got started, we were up a little bit less. We're continuing to push to the upside after hours. It's currently around 103. which would take us up by the trash can on the stock charts chart here. So, I think going into earnings, we've highlighted Palantir as just an example of a classic uptrend phase, higher highs and higher lows. If there's a concern for Palantir going into today, it's some of the bearish divergences. But the way that you negate that is by continuing to push higher. So we'll see how tomorrow opens up. I would imagine much higher, but certainly seems to be continuing this theme with Palantir of strong earnings release, big gap higher, and then the stock continues to run. Looks like another strong earnings win from a well-followed software company. Other names reporting earnings this week. Tyson Foods actually reporting today as well. I don't know if we can see what's going on after hours with them. Not much change today, up about 0.7% in the after hours. But they might have reported before the open. I didn't look too closely. But I would tell you with TSN, what's interesting about charts like Tyson, like Clorox, some of the other consumer staples reporting this week is that consumer discretionary has been outperforming consumer staples for so long. I call that offense versus defense. And strong earnings from some of these consumer staples companies could, be part of that story where staples starts to outperform and would be a very big risk off signal if you finally get consumer staples outperforming consumer discretionary. It's not been the case for many, many moons. TSN has a lot to prove from a technical perspective, and I would say going into today's earnings, interesting setup because you have the October 23 to September 24 rally, 38.2% of the way down is around 58.50. You can see that lines up, pretty well with the pullback here in September, October. We also bounced off the 200-day moving average, so kind of a confluence of support there. We traded back higher, ended up making a bit of a double top kind of pattern, and then rotated lower, broke below this support level and the 200-day. Now we're testing the 38.2% level from below. So I think getting back above that 38.2% level, I'd probably wait for it to get back above the 200-day. That could be a nice recovery for Tyson. We'll see if there's enough momentum after earnings through the course of this week. But I would keep an eye. A ton of S&P names reporting this week. And don't just focus on the big, widely followed technology names. Follow things like staples, follow healthcare, follow some of these sectors that have been underperforming, but maybe showing signs of life because potentially that's where some of the next opportunities come. All right, let's see. Akira, thanks so much for watching on YouTube. You asked, Dave, hope you get well soon. Oh man, me too. If you knew how much I was struggling to get sentences out, you would, I hope, have sympathy for me. It's been rough. Palantir seems up big after earnings. Can you share some thoughts on what investors can do on such a big move after earnings? So I tell you what, when you're investing in individual stocks, this is one of the risks that you have, right? And I think one of the arguments for not investing in individual stocks and just putting your money in ETFs is you're not as exposed to what's called earnings risk, right? With companies, with individual stocks, you have some company specific risk. And the most common one would be earnings. And what that means is just the likelihood of the company to move significantly around earnings releases. A couple things you can do on something like Palantir. Number one, I think you assess the trend going into earnings. And, it's been clear that Palantir has been in a fairly constructive trend going into today's announcement, right? At a time when, we saw how many stocks were at the lower end of the range, testing support, NVIDIA, Apple kind of things that are pulling back, Tesla breaking down, Palantir, Visa, MasterCard, Meta, these stand out because they're in primary uptrends, undeniably so. So I think the fact that the trend has been so strong over the last year or two is probably the most important argument to pay attention to. Number two, you look back at previous earnings releases. You can see they report on February 3rd, beginning of February, which means they last reported here beginning of November. We can see this is an earnings release early August, and you can sort of backdate and see some of these previous announcements. What's striking about Palantir is a number of times over the last 2 years, you've had a nice earnings surprise, a gap higher, and then it continues to run. And I think that's important to remember as well. Other than that, you have to just wait and see. A lot of people, if you're short term, if you're swing trading, I would say owning a stock going into earnings is a very risky conjecture. because you are basically opening yourself up to a huge binary outcome. As a medium-term or long-term investor, I think it's good to know when companies are reporting earnings so you can prepare for that volatility, but generally use that additional information to see if that changes your thesis about the stock. From a technical perspective, earnings are one of those realities about investing in individual stocks. They will have binary outcomes. They will gap higher. They will gap lower. The most important thing I would argue is assess the trend going into earnings. Certainly analyze what happens the day after, right? So tomorrow for Palantir, we're going to gap higher. Do you see additional buyers coming in? Do you see a bunch of people selling that strength? That can tell you a little bit about investor psychology going forward and where people's head are at, and go from there. That's how I would think about earnings. And again, a number of people that I've worked with, I'm thinking of like Tom Bowley at Earnings Beats, Danielle Shea at Simpler Trading, have done a great job looking at trends in earnings, how much a stock tends to surprise, and looking for strong companies, consistently beating earnings. That's what Tom does, I would say, very, very well. So hope that helps. All right. What else? We'll do one more. Can you kindly see BCE stock is paying a 10% dividend? It's a Canadian stock on the NASDAQ. I don't know this name, I don't believe. So let's take a look. Oh, no, I do know BCE. Crazy dividend. It's, the dividend yields above, it's almost, 12%. Stock chart is saying 12.2%. A lot of times you can get different yield quotes because it's all about how you calculate it. I mean, dividend yields are kind of an estimate based on what you think you're going to get as a dividend payment over the next 12 months. So the methodologies can be very different, but it's about a 12% yield, which is pretty key. So here's what I would say. I know that that dividend yield seems super tempting, and I don't blame you for thinking, ooh. And I remember AT&T having a huge yield at one point. And the problem is because the way that the yield works is, if it goes from 34 down to $22, all of a sudden the yield goes from like 7% to 12%. And I'm flubbing the numbers a bit, but you get the idea, right? The yield is basically how much you get in a dividend versus the share price. So there's two ways that number can look so good. Number one, the company starts paying a much heavier dividend, and or the price of the stock goes down so much. And that's what's happening with names like BCE. I would tell you, when you take the dividend adjustments out for BCE, I mean, this is a stock that's been going down that's brutal, right? That's a brutal technical configuration. So even though the yield is really good, it doesn't, I would argue, compensate for the fact that you've had your lunch completely eaten by the markets over the last 3 years, right? I think that's one of those things to be wary of with higher yielding names. Remember that often means the stock price has come so down so far that the yield looks very, very good. Now, if you're buying a recovery story and buying it down here and hoping that the price appreciates, and all of a sudden you've locked in a pretty low price for that dividend, more power to. I think that's a great approach. But I would say from a technical perspective, still tough one to justify. And the reason I would say that is because, from a long-term perspective, we're below two downward sloping moving averages. We keep making lower lows and lower highs. None of that is good. As I'm saying that, though, I'm interested by the fact that we have a hammer candle a couple weeks ago. That's interesting. After another kind of hammer candle-ish thing at the end of December, we're testing that resistance around 24. For me, though, I would say, given the number of stocks out there that look so constructive, buying a name like this that's so beaten down, I don't see the argument necessarily. I'd much rather buy strong charts getting stronger and not one showing consistent weakness. Folks, that's it for today. Thanks for hanging with me with the getting through the flu, but I appreciate you joining me here. And I want to thank you so much for supporting me and Market Misbehavior. As a reminder, the questions we didn't get to, we will put them into our mailbag, and we'll hope to answer one of your questions in our all mailbag episode on Friday of this week. For Market Misbehavior, I'm Dave Keller. Have a great night, and remember, it's always a good time to own good charts. Take care, folks.